All right, hello and welcome to the Yet Another Value podcast. I'm your host, Andrew Walker, and with me today, I'm excited to have, for the third time on the podcast, my friend, Jon Boyar. Jon, how's it going?
Doing great. Thanks for having me again.
Hey, thanks for coming back on. Let me start the podcast the way I do every podcast. First, a disclaimer to remind everyone, nothing on this podcast is investing advice. Everyone should do their own work, consult their own financial advisor, all that type of stuff. And then the second way I start every podcast is with a pitch for you, my guest. This is your third time on, which I kind of think speaks for itself as a pitch, but it makes you our second most popular guest of all time, right behind Jeremy Raper, who's just running away with the title. But, I think one of the things that I wanted to pitch was, I know you've got the Forgotten 40. I think you're going to talk about that. We're going to talk about one of the stocks in the Forgotten 40, but it's a really nice product. It's a great way to start the year with it leads a little bit on the media and cable side, which is right up my alley, but it's a nice way to start 40 stocks trading at reasonable values, probably good growth prospects, a nice quick overview of all of them. So I really enjoy that product, and I'm glad we can talk about one of the stocks on there. So all that at the way, the stock we're going to talk about is Scotts Miracle-Gro. The ticker is SMG. I was bugging you. I was like, there's cable companies in here. There's media companies here. Let's talk about them. But you were saying, no, SMG is the one I'm most convicted on. I'm really excited to talk about it. So I'll turn it over to you. What is SMG and why are you so convicted on it?
First, again, thanks for having me on the show. And Scotts Miracle-Gro is an interesting name. And I guess to start with a little background, just on our firm, one of the things that we're really attracted to are great consumer franchises. That's something that's critically important to us, really, for a few reasons. One, it gives them a sustainable competitive advantage. It's very difficult to replicate a great brand. Takes a lot of time and a lot of money to do so. Especially the time we're in now where, I know when we were talking yesterday, what type of an economic environment we're in, and, it appears we're, headed for some sustained inflation. And one of the ways, I think the best ways to invest in a period of sustained inflation is through companies that have great consumer franchises, as they have the ability to raise prices. In fact, they just announced for the third time in a year that in their core consumer business that they're going to be raising prices. So I
was going to say the exact same thing. I was reading through the earnings call last night, and they said third price increase in the year, and I was like, oh, if that's not a sign of a little bit of pricing power, I don't know what is. 3 in 1 year. Wow.
Yeah, no, that speaks to the power of the brand. They have, everyone really knows about, Scotts, their traditional, they call it their consumer business. They have 4 brands that, each that comprise most of their sales, each of which has kind of like Coca-Cola like market share. They're also, involved in
You just want to list those 4 brands just for listeners?
Like you have Ortho, you have Scotts, you have, all those types of brands that if you go to any home and garden center at Home Depot or Lowe's, which are, one of the things that's a little risky is, they comprise about 40% of their sales in just those 2 retailers alone. But the powers of the brand are fantastic with them. And, Roundup, they're the exclusive agent for Monsanto in them as well. That's about 10% of income or so. So they have these great brands that anyone who's a gardener or who does any sort of, outdoor type of stuff knows very, very well. And the stock, in April of 2021 reached about $253. It's now high 130s, low 140s or so. It's been, trading around a bit, and I'll talk about the reasons why later on. But just going back, it's been a huge pandemic beneficiary.
Yep.
They picked up about 20 million new customers during the pandemic, and by their surveys, et cetera, they think about 86% of them are going to stay. In addition, millennials are huge for them. I went back and I looked at, we've been following this company since about 2010, 2011. We've written research reports on them and owned them for stocks. Full disclosure, I own it, my clients own it, et cetera. One of the things that we were talking about as a catalyst is the baby boomers retiring. That was a big deal. They're literally going to retire and watch the grass grow. But now it's millennials that are driving it, and they have things like edible gardens and things like that, which are a huge growth area. And this was a business that they thought was going to be a 1% to 2% grower, going forward.
Yep.
Now they've kind of said this is going to be a 2 to 4% grower going forward. So that's a huge shift. Over the last couple of years. It's a great way of playing demographics, etc. All the millennials moving to the suburbs, having homes, and it's that's one part of their business, which is the.
Let's focus there, because there's lots to talk about. Like, we haven't even started talking about Hawthorne yet, which I think is the more exciting, growthier part of the story. I listened to your podcast with the CEO from, I think, early December, and he's fantastic. I mean, I'm surprised I don't hear more about him with the outsider type stuff, but we can get all there. But I want to dive into you've obviously started by focusing on the core business, the Scotts Miracle-Gro, the consumer side of the business. And I just want to start there with two risk factors. I think you were starting to address them, but just to dive in a little bit. The first is, you mentioned these guys have Coke-like share with their brands. And I get it, like Scotts Miracle-Gro, I've seen the ads, I get that. But at the same time, my mental model is like, the best brands are things that you personally consume or display, right? So a Nike would be a display. That's a status symbol. Obviously, the super high-end like Hermes and stuff are status symbol, or stuff you consume. So a Coca-Cola, everybody's got the taste test where like Coke and knockoff Coke taste basically the same, but because Coke spends so much on brands and you put in your body, you prefer that over a generic. Or even something like Tylenol, right? Tylenol is ibuprofen, right? But nobody really, people do take generic ibuprofen, but most people go for the Tylenol that's consumed. When I think about Scotts Miracle-Gro, like, it's one of those things, I'm surprised that there's so much brand strength here, just because nobody knows if you're using Scotts Miracle-Gro or a knockoff. It just strikes me as one of those things that's very ripe for private label disruption and that type of stuff. So I said a lot. I'll turn it over to you on why the brands are so strong.
Well, you mentioned displays, which are interesting. So I guess one way I'd say is people's lawn, if you look at it, Scotts would say you'd be able to tell if you're using a cheap knockoff, as grass isn't greener, it's not growing well, that their products are actually better. They're involved in private label. They do produce private label, and that's one of the things that they do for both Home Depot and Lowe's. But the product is inferior. And the other thing that's important is, if you're doing some lawn care, etc., you're essentially doing it once or twice a year. You have one shot of doing it, and you really want to cheap out and pay a couple dollars less and have the risk of your lawn or your garden looking terrible, because that's like a showcase for your home.
Why are their products so much better than the private labels? Because I know obviously there's chemistry and biology and stuff in here, but it doesn't strike me as crazy hard chemistry or biology. Scotts Miracle-Gro was around in the 80s and 90s. I'm not sure you've seen like leaps and bounds improvement. Why is it so much better than private label? Or is that just something they say? Like, are there actual studies that show that these are better than private labels?
Yeah, they, as I said, they also produce a lot of the private label. I don't know the exact share of it, but they produced a fair amount of it, and they purposely make the ingredients less powerful, less, not as good. So it's part of their strategy. And one of the things that's interesting, one of their competitors, Central Lawn and Pet or Garden and Pet, in their filings, they actually put as a risk factor that Scotts basically owns the category. That it's very hard for them to compete. So whether it's perceived or actual, and I think it's probably a little bit of both, they spend lots and lots of money, not only on marketing, but also in research and development.
Central is the brand, is Spectrum Brands owns that? Am I remembering that correctly?
I think that's another one. Central Home and Pet, I believe, is the.
I thought it was a division. I could be wrong. I thought it was a division of Spectrum Brands, which it's just top of mind because I think they announced the spinoff this morning. So I've been meaning to go back and refresh. Let me turn to the second risk factor I want to talk about. And you mentioned private label. They make private label for Home Depot and Lowe's. I think you've addressed the private label side, but I do think there is, you said it, Home Depot, Lowe's, 40% of sales. That is a lot. I do worry that this is a category that people could be prone to switch to private label. I think you did address why they might not want to for a couple of bucks, but I'm still a little curious. I want to talk about the concentration risk. And I know somebody just tweeted at me. They said, hey, actually, if you case study this, Walmart tried to private label in 2017 or 2018, and then kind of like begging back to Scotts and saying this has not worked well. So if you want to talk about Walmart in the context of private label risk, I think that'd be great too.
Yeah, I guess you have to really look at the private label risk. I mean, it's certainly important, talking about it. I mean, look what happened with foods and supermarkets and things like that. Everyone thought they had these great consumer brands, and then supermarkets decided, why don't we produce this ourselves? But this is not like making a cracker. This is a lot harder. But going into concentration risk, it's roughly 40%, 2 stores. They also had to do a fair amount with Amazon. Part of their strategy is to be fantastic partners. If you go into a Home Depot or a Lowe's, you'll be greeted by Scotts actual employees who are there who are helping them out. So they're actually being used as a resource for Home Depot and Lowe's that help drive sales, and they help bring people into the store. These people are enthusiastic about their, about their garden, it's one of the purchases they actually kind of like to make. It's done in the springtime, the weather's good. So that helps, mitigate it. And, I think the proof's in the pudding. They raised prices twice so far. They're just instituted a third pricing increase. Their biggest, 40% are in Home Depot and Lowe's total. So if they're able to do that, it seems like they have pretty good negotiating leverage.
Perfect. I want to turn to Hawthorne in a second, but I guess we might as well stick with risk factors because this will apply to Hawthorne as well. Both the core business and Hawthorne, and we'll again talk Hawthorne in a second, were massive COVID beneficiaries, right? And you mentioned the stock's gone from 250 to around, I think it's like 135, last I checked. It's a huge drawdown for a consumer staples franchise. Obviously, a lot of people are seeing they're lapping COVID, the comps are going to be negative. And I just keep thinking like, I think in like 2019, so pre-pandemic, they earned about $5 per share. And then their trailing numbers are probably around $9 per share in earnings. And there's all sorts of movements, price increases, they've done acquisitions. But I guess a lot of people look and they, the mental model, not the mental model, but the thing I've got in my head is Peloton, right? Huge COVID beneficiary. As soon as they start lapping, they've way overinvested into their supply chain. And people say, oh my God, this is going to fall off a cliff. And I could see something similar with Scotts Miracle, right? Where you say, hey, maybe sales got too far ahead of themselves. A couple extra people who really don't want to be gardening are going to be gardening. They probably overinvested in their supply chain. And when things normalize, like it's not going from 9 to 5, maybe it's going 9 to 3 is the super bear case. I don't think that's likely, but I'll just turn all of the thoughts on the COVID lapping over to you.
Yeah, I mean, that's certainly a risk, but one of the things I'd say is you now have a shift of millennials moving out of their parents' basement or from the cities or whatever to the suburbs, creating new customers. That's huge for them. Two, if someone went to the trouble of producing a garden or doing that type of things, they kind of have some fixed costs and fixed time investment that they're probably going to continue doing this. They've created all this work, and it's just going to sit there otherwise. So I think, and you're looking at their latest call. If you read through it, Q1, their first quarter of the year is not a huge one for them, but they're looking at the point of sale data. They've been pretty impressed that people are staying with the category. So yes, it's certainly a risk, and that's clearly what the street is saying. But I think the difference also with Peloton and this was an established company to begin with that was growing, not as fast as they said they were going to grow, but it was growing nonetheless. So I think the comparisons probably, I would think, end there. But yeah, it's down from 254 to 130 and change. For a variety of reasons, margins, worry about COVID comps, etc. But I think if you really look at that price decline and you put, let's say, and we can talk about this in a second, a cannabis ETF over it, it kind of perfectly correlates, and that's because of the second business, Hawthorne, is really one of the ways people have been playing cannabis. And just I talked about consumer franchises, and that's one way that we've invested. A subset of that is great consumer franchises that are masked by a corporate name. And this is sort of the case with Hawthorne. Hawthorne's not known by most people, but it's known by people who are in the cannabis business. It's one of the best brands out there. And that's what makes this such an appealing investment. And the way that we look at it, and we can talk about valuation later, and I know we want to talk about the Hawthorne part, is essentially at these levels, you're purchasing the Scotts consumer business and getting a fast growing Hawthorne cannabis business essentially at zero cost. So to me, this is like the true value investor's way of playing cannabis.
Yep. Well, let's switch to Hawthorne. I do just one last thing on the core business. I loved what you said, where people have made a time investment into the thing. And I do think like there are some COVID beneficiary things. Like everyone was baking bread at the height of COVID. Maybe anytime you get new consumers in the store, I'm sure a couple of people are going to stick with the bread making going forward, but most people have probably dropped the bread making. But something like gardening, that is something you've made a big investment. You've got the house. Not everyone will stick with it, but I think you mentioned, or they mentioned on a call, 86% of people are going to stick with it or something. I would bet that's directionally correct. Or you can move away from gardening, like something like fishing. Tons of people took up fishing during the thing. And yeah, probably less people stick with fishing than stick with gardening because there's a little bit of extra work there. But I bet you a lot of those consumers are going to stick with fishing. I mean, you have to go buy a rod. You had to go get a fishing license. Like there's big investments there. And then, fishing's been a popular sport for hundreds of years. Like once you pick it up, some people are actually going to like it. So it's not going to be 100 for Scotts Miracle-Gro. I bet you it's 75 or 80%. For fishing, I wouldn't be surprised if it's 40 or 50%. But
I agree. In remote working certainly is helping for these type of activities that you might not have as much time for, and people are spending more time at their home and they're investing in their home. The other, another stock that was in the forgotten 40, we can talk about it another time, is Callaway Golf. That is, golf certainly was a huge COVID beneficiary. Yep. And, I think a lot of people there are going to stay. So
and if you took up golf, guess what? You spent a couple $100 on equipment and stuff. You spent hours and hours and hours. Golf is not a game you go and you pick up in 3 minutes. You've spent hours and hours practicing your swing. Maybe you hired a swing coach. Maybe you've just sunk a lot of investment in there. And yeah, a lot of people are going to churn, but I do think all these businesses have been taken up to the next level. Let's talk Hawthorne now. Hawthorne it's the cannabis play. It's the sexy part of the business. It's going to be rocky, but it should be a really growthy story for a long, long time. Great tailwinds. So, what is Hawthorne? How do they touch the cannabis thing? Why is this brand so good?
Yeah, well, I think that's the thing. They don't directly touch it. They're essentially a distributor to a distributor. They have anything that you need to grow cannabis without actually touching the plant is what they do. They provide a lot of lighting, filtration, air filtration, anything they need. And what's interesting is, at least in the US, because of legal reasons and banking and all of that kind of stuff, their customers, their direct customers are not the growers. They have about 1,600 or so kind of specialty stores that sell this kind of stuff, as well as Amazon, .com, where what they do is and 70% of their stuff is proprietary products. So what they do is work as consultants to the growers, tell them how much lighting, what type of lighting they need. This stuff is super important. This is not, this is very technical things, and it also relates very well with their other previous business.
There was a quote in, I think it was their investor day, where they said, look, it's easy to grow cannabis indoors. It's not easy to grow good cannabis indoors. And their consultants are out there helping people, providing you with the technical knowledge and the tools to do that.
Exactly. And in Canada, it's different, where they can sell directly to the growers because less, regulation there. But they work as consultants. They've quickly grown this to an over $1 billion a year business. It grew 100% over the past two years. They're making acquisitions. They grew this pretty much from nothing. It's run. And one thing to take a quick step back is, for better or for worse, and I think in this case better, the company's about 25% controlled by the Hagedorn family. So you have, a controlling shareholder there. And, one of the things that he also said is, in the last call, and I think is super interesting, is you have to take an activist. He has a ability to take an activist approach at his own company. And, Hawthorne is an example of this where, he decided in early 2012, 13, around then, to get involved in this category. And it's been growing. It's being run by his son, Chris, who seems to be doing a fantastic job. But it's a super interesting growth story. And they know who the really good growers are. And through debt and preferred investments, they're taking stakes in them because they can't take actual equity stakes in these growers because of legal and banking regulations. But once safe banking passes, and it will, I think it's a matter of time. That's a huge catalyst for them because the value of their investments will go up as well.
We'll talk. We'll talk the investments in a second because I do agree they're interesting, though it's a little different than what everyone else is doing in the space. Let's stick with the core Hawthorne business, though. I don't think it'd be crazy to say again they're providing the lightings, the airflow, and everything. It's a picks and shovel play on weed industry growth, right? I want to ask two things on it. First, and this comes back to a little bit the moat question and the brand question I asked about Scotts Miracle-Gro. But a picks and shovel play, I get everybody loves to provide the picks and shovel play. But when I see lighting, I'm like, oh, lighting isn't, again, it's not that technically complex. I don't think there's huge benefits to scale in terms of making the lighting. Obviously, people want to go with the lighting that's going to work the best, but I have trouble believing like buying lighting is something that's really brandy. So I just want to dive into like, what is the moat here? Because one worry I have is 2018, when the weed industry was in the doldrums, to 2021, there's this huge boom. And they say we're the best business, we're the best moat. And one of my worries is, well, maybe there was just so much demand and it's so far outstripped supply that you guys were just a huge beneficiary of this. And once like kind of supply demand normalizes, we're going to say, oh, these guys were just selling, hardware commodities, and not that it can't be an okay business, but it's never going to be a great business. And the brand was a little overstated. That all makes sense?
Yeah, no, that makes perfect sense. And that is a worry of ours, but it seems that in the kind of the same model that they're doing, helping Home Depot and helping Lowe's, anyone can, with enough expertise, create, all sorts of lawn and gardening kind of products. They're doing the same thing with Hawthorne, and they're helping and being value added to all of the major growers out there. And they're kind of putting themselves in their process and their research and development process. And that's really what's going to be the, sustainable competitive advantage. I mean, at the end of the day, cannabis is a commodity like anything else. But if you're able to have kind of a branded type of business that we're Hawthorne, we can help you, be the best grower possible. I think that's a really big moat, and they certainly have the first mover advantage. So they're going to, I think if they're able to take some of the same playbook that they did at their core consumer business, they should be able to do that in this business as well.
This might be a little bit of a stretch, but is it almost like Hawthorne is a little bit of a consulting agency where, they will, the real mode is they've got all the experts who can come into your business and tell you, oh, you're not doing this, you're not doing this, you're not doing this. This will improve your yield by 5%. And because that side of the business is so valuable, like people are going to buy the Hawthorne lighting and everything just because the consulting side is so valuable.
Yeah, I think that's exactly what they're trying to do, especially since they can't actually take physical orders from the growers now. They have to do it at the at these 1,600 or so stores.
So let's talk about that. Obviously, federal legalization, I think, would be a big catalyst for Hawthorne, but I do worry. I believe when states legalize cannabis, their business actually initially drops as all the illegal growers stop buying, and then it takes time to go and find the new legal growers and build, and that takes a while. I do worry like federal legalization comes in, and right now Hawthorne has to sell through distributors who then sell it to the end users. Federal legalization comes in, and Hawthorne said, then we can start going and selling directly to the consumers. But does that moment of uncertainty and change, does that present an opportunity for other people to come in and beat them to the direct to consumer punch?
I think they just have
direct to distributor. I'm sorry, direct to grower punch, the direct to grower punch.
Well, they have all these established relationships, and through their investment in that Canadian company that's taking these stakes in growers and other brands, they kind of have the inside track there. So I think that they have a huge head start. And listen, there are plenty of companies, if you look at history of business, that were the first movers that didn't end up becoming a long-term competitive advantage. But in this one, I think they have such a good head start, and I mean it's already a $1 billion a year business from basically nothing 10 years ago is pretty impressive. And it doesn't necessarily, I think genie's out of the bottle, cats, whatever the expression is, we're not going backwards in terms of cannabis regulation. I think that's highly unlikely. It's just a question of degree. How many more states legalize it? I mean, New York is going to be legalizing, I believe, sometime this year. That should obviously help the business a lot. But it's really the safe banking reform that will be the big driver for them. I mean, when I had him on the podcast, I had no idea that essentially, if you are a business that grows cannabis right now in the US, you can't deduct any of your expenses on your income tax return. So effectively, you have an 80% tax rate. I mean, how does that work? I mean, it's just silly that they haven't had a comprehensive reform on this. This is something that shouldn't be in this kind of legal limbo. And at some point in time, I mean, I think part of the reason why the stock went down from 254 to 130, 140, wherever it is now, is there was a lot of excitement that the Biden administration would be able to get safe banking, get federal cannabis reform, and clearly that's not happening anytime soon, but at some point in time it will happen.
Yep. Aaron Edelheit's been on the podcast and talked about cannabis plays a couple times. And one of the things, like, I'm making the numbers roughly up, but he's like, look, you look at all these cannabis plays, they trade for 5 times EBITDA. They're growing 40% a year, but because they can't deduct anything from taxes, it's like they trade for 5,000 times free cash flow or something. But if you assume they can ever start deducting, it gets very interesting. On Hawthorne right now, they are going through a growth slowdown, right? And I think the argument is, hey, things went crazy good during the pandemic. Everyone was buying lighting. They were buying ahead of time, all this sort of stuff. There's a slowdown right now. And I believe that, I get that, but it's a picks and shovel play. And it's not like demand for cannabis is slowing. I get that the industry is struggling because they probably got into oversupply, but I'm still just a little surprised that a picks and shovel play is having a slowdown when the industry is so immature and seems to be growing so quickly. So can you talk a little bit about the current slowdown at Hawthorne?
Well, the current slowdown at Hawthorne has a lot to do with, there's just a big black market supply of cannabis out there, and that's impeding things. The legal growers aren't buying as much, but it grew so quickly in such a short amount of time. I mean, there's going to be kind of growing pains. This happened to them 2018, 2019, and it just look at this. The business grew 100% over the past 2 years. This is not going to be kind of a straight line up, and they're forecasting, and so far they're generally pretty the straight shooters there, that second half of the year there's going to be a turnaround, and it seems almost inevitable because you're just having more and more states legalize cannabis. And also part of the issues are just going to self-correct, where you have a big oversupply of cannabis. This is a product that has I think a 1-year shelf life. So at some point in time, you're going to have to regrow the cannabis, and that should help them.
Perfect. Last thing I want to talk about on the Hawthorne side, and then maybe we can go into some of the parts, and there's a couple other things I want to talk about. But on the Hawthorne side, you mentioned they put $150 million, I believe, into a strategic investment into RIV Capital, which is a big kind of like weed incubator, I would say. And they're taking other, as you said, they can't take equity stakes, but they're taking lots of convertible preferred or convertible debt where the second safe is regulated. They can flip it in and they'll have lots of stakes in people. It's an interesting strategy. I understand it exposes them to a lot of growth, but at the same time, I know a lot of people would say, hey, how many picks and shovel plays actually need to go invest equity into their, Amazon AWS isn't exactly taking 10% equity stakes into every company who comes and gets onto AWS. So just want to talk about that strategy a little bit.
Well, I think it seems more it's opportunistic in that they know who the good growers are. And obviously it helps them get customers later on in life. But if they are able to see who these big brands are going to be 5 or 10 years in the future, and they're able to get them at really reasonable rates because there's no great outside funding available for them. Yep. Why not? This shows them being opportunistic. And this is why we really like kind of family controlled businesses, because they're looking 2, 5, 10 years ahead and not looking to kind of maximize earnings. It would be better if they, in the short run, if they just did a massive share buyback here with that $150 million, they put in to RIV or whatnot, but instead they're investing kind of into the future, which I think is the better move.
Yeah, and in this case, like I use AWS as a counterexample. AWS's customers, they're not exactly having trouble raising venture capital money or anything, right? Whereas a lot of the Hawthorne customers, there's absolutely no capital. You cannot borrow from a bank because of all the safe stuff. So it's possible, Hawthorne, Scotts Miracle-Gro borrows like 20-year paper at 4% or something. These are investment grade people. They're taking that and they're obviously it's very risky, but they're lending to people who are going to buy their products, and they're probably doing it at like 20% plus, like kind of, I don't want to use loan shark, but very attractive rates, probably risk adjusted. This is a really good bet, especially when it's growing the Hawthorne moat. Do I have that right? Or do you want to add anything there?
Yeah, no, it's really kind of a tale of, two credit markets really out there. I mean, there was a really interesting article in the journal today about zero coupon, convertibles, where, I never understood this because I think Dropbox did it and a couple others. There are a whole host of companies out there over the last 2 years that have been able to issue convertible securities at 0% interest rates. It's absolutely insane. Those are the AWS customers. It's really not true in the cannabis space.
Or we talked about Peloton did it, and a bunch of other growthy companies did it. They all did it in February 2021. Volatility was insanely high because of the meme stock squeeze and everything. And for a lot of them, it's been an absolute lifeline. Peloton issued, I think, was $1 billion of debt, and I think it converts at like 130 or something. Go look at the Peloton stock price. I don't think that's converting into money, but because the volatility was so high, they could do that, and they could get stuff that really funded them and helped them. And you're exactly right there.
I wonder, just going back, who was the buyer of that?
It was convertible arbs guys, right? They bought it, and then I'm sure they instantly shorted the stock or sold lots of options around it, because the IV on the stock was so high. I think you could do stuff and kind of create it and get a really attractive yield on it. So I'm sure there were really smart mathematic guys with like PhDs in finances who were figuring out risk-free ways to buy these things and generate like 5% annualized, and they were borrowing at 2% or something. I don't know. I just want to, one thing you mentioned, this is a family-run business. They look with a 2, 5, 10 year. And again, I listened to your podcast with the CEO. I thought he was a hoot. He's obviously, he might have, you might have to censor him if he's on TV for too long or something. But there was one story he said where his board went to him when he was about to invest into the weed industry, and his board was like, hey, we want you to, I'll let you tell it. But I thought it was really instructive of how they look long-term and probably what they're seeing, the bet they're thinking about with the weed industry today.
Yeah, no, originally they basically said, no way, we don't want.
The board said no way, right?
The board said absolutely no way, but he effectively controls the board, but he tries to have built consensus, but he thought it was just such a great opportunity. He was visiting, I guess, some stores out, I think, in the Pacific Northwest, and he just saw that people were spending money hand over fist on this thing, and he decided to, say, no, we're doing this. He did it slowly, And he stepped on the gas when he needed to. And, there are certainly issues when you have family-run businesses where, in the short and medium term, it could frustrate, people. But I look at them and their long-term records, they're fantastic capital allocators. When the stock was in the 240s, 250s, they're talking special dividends. Now they're talking, stock buybacks and no special dividends. So this is, they treat us the money like it's their own, and it's 25, 30% is their own.
I think in that story where he was going to when they were about to get in Hawthorne and they were talking to growers and stuff, I love where you'd go to the people who are buying all these systems in straight hard cash, and you'd be like, what are you buying these for? And they would just stone face look at you and be like, we grow a lot of tomatoes. We grow a lot of tomatoes. We need lots of hydroponics to grow tomatoes, and we buy in cash. I just love that.
Yeah, the tomato business ended up being very profitable.
Let's talk some of the parts here, right? Yeah. So high level, $135 stock. I think EPS is around $9 per share. So 15 times earnings. That is not a lot. That is probably on the cheap side, given they borrow at, again, 10, 20-year paper at like 4%. This is a consumer brand, go look at a Procter & Gamble or a Coke or something. It's a consumer brand that they now think can grow 4 to 6%. And it's got this really interesting cannabis play. Let's dive a little bit further than in just the headline PE number and talk. There's the Hawthorne side, the cannabis side, fast growth, and the Scotts Miracle side. How do you guys look at the overall value here? And this will be instructive because they might spin off Hawthorne at some point. So this can build into that conversation as well.
Yeah, no, absolutely. And if you want, we recently issued a report on the company, I think in full length, I think in July. I may have sent it to you if you want to have it so your readers can see it. I'm happy to give you a link.
You did, but if you give me the link for listeners, I'll be sure to include a link to the Scotts Miracle note in the show notes, and I'll also include a link to the Forgotten 40 if you're interested in that in the show notes as well, just for any listeners.
Yeah, no, fantastic. This way they can actually see the assumptions that we do, et cetera, on it. But we look at everything, and this is the way our research and our money management arm works, through the lens of an acquirer. What would a knowledgeable business person pay for the entire business? And basically, we estimated what 2024 EBITDA was going to be for both consumer and Hawthorne. I don't have the assumptions off the top of my head, but they were not heroic assumptions by any way, shape, or form. And taking, I think, a 14 times on the consumer and a 50 times on the Hawthorne.
Is this 14 times, I'm guessing, net income, but I just want to drive that home.
Yeah. It gets EBITDA. It gets us to $243 a share or so. I mean, could be wrong, 10% plus or minus, but you have 130 some odd dollar share price, and you have we think it's probably worth in the 240s. And the thing that's critically important to us is, for any VC, you have to worry about value traps, especially in family-controlled companies, is the catalyst. What's going to make the stock ascend in value over a reasonable period of time? And to us, a reasonable period of time is, 2, 3, 4 years. And one of the catalysts, besides the legalization, safe banking, all that kind of stuff, is they said they might split the company up over the next 1 or 2 years into 2 businesses. And I think it makes a heck of a lot of sense to do it, even though there'll be some dyssynergies as the businesses are related. But it makes a lot of sense because maybe not at this moment in time, these cannabis shares are out of favor, but at some point in time, the market's going to value these things very, very differently.
Let me push back on that because, I'm a big fan of spinoffs. I'm a big fan of financial engineering. You and I talked about IAC a lot before. I love that IAC, they build companies up, and then when they're ready to stand on their own, they spin them out. They're not trying to conglomerize. But the Hawthorne spin was interesting to me, right? Because I get it. If everybody's trading cannabis companies at 100 times EBIT post legalization or something, you want to spin this off and you want to capture that multiple. But on the other end, the great builders that I've seen, they kind of ignore, hey, the market is the market's a little hot for this side of the company, so let's try to play into that and financially engineer it. Like they look towards long-term value. And I think they said, because research between Hawthorne and Scotts Miracle-Gro, it makes sense. There's a lot of overlapping research and distribution and stuff. They said if we split these two businesses, I think it'd be $50 million per year in dis-synergies. And like $50 million per year, this is I think it's a 6 billion market cap company or something. Like $50 million a year in dis-synergies and costs. That is a lot of money. So I was just a little surprised because the CEO, go read some of the stuff he says, go listen to Jon's podcast. This is a guy who like kind of he fits the outsiders type mold. And I was just a little surprised that it seemed like he was willing to entertain a split with a lot of dis-synergies for what it looked to me. He wanted to catch a sexy growth pop, or, catch a multiple that may or may not be there, if that makes sense.
Yeah, I think the reason why he wants to do it is not necessarily to, get necessarily a shorter term, a higher stock price. It's that if he wants to take stakes in some of these other businesses that are kind of wildly inflated, he needs his own currency. And he's just not going to get that currency as part of kind of a quote unquote conglomerate.
Why does he need his own currency? Because I get it, like your own currency, you mean he needs Hawthorne to be able to issue equity to buy these things. But why does he need his own currency? Because I look at the Riv Capital deal, like we talked about how right now all of these companies are cash starved, right? They'd rather cash is gold to them. They'd way rather cash than like partner for equity. And Scotts as a whole conglomerate, I've said several times, they borrow 10, 20-year paper at really low cost. Like it seems to me, they don't need their own equity. They just need the low access cost of capital to keep funding all these deals.
Well, I think the market would just value them so much higher that they would be able to use the equity to buy some of these other businesses that are not so advantaged. And, he was talking on the podcast about some of these businesses that are, being sold for $1 billion, $2 billion. And, the whole enterprise value of Scotts itself right now is $10 billion or so, when you include the debt. So I think, he wants to be able to, have a seat at the table and not be minority partners with these folks and be able to take majority or, somewhat controlling interest. It's a tough call. I think at the end, he's going to do what's right for shareholders. Obviously, there's also family issues involved. Like he wants his son to stay at the company. But I float another thing out there is one, you get different. There are people who will not invest in Scotts right now because of the cannabis. I know from selling my research, there are people who I start talking about it. The minute I say cannabis, they say stop. That's I think a huge part of that story. And two, I'm not saying he would do this, but think about, it's a parlor game. What kind of business would Warren Buffett buy or Berkshire would buy? Scotts kind of fits that to a T, the traditional consumer business. Maybe one day, because it seems like the son is very enthusiastic about the cannabis business, less so about the regular business. Maybe one day they sell the consumer business. I'm not saying to Berkshire, that was just as an example. And that's a way for the company, the family to cash out and, run with Hawthorne.
It's so funny you say Berkshire, and I agree. Scotts would make a great candidate for Berkshire, but honestly, Berkshire is so big at this point. Scotts a drop in the bucket. I don't even know if Warren Buffett wakes up for that phone call anymore. It's just funny.
Yeah.
The other thing I do remember on your podcast, the CEO talked about how 2007, I think Henry Kravis approached him and was like, "Hey, let's just take this thing private. You're going to make so much money. We're going to lever it up, take it private." And he said, "I get you. But, all you're going to do is take out a bunch of cheap debt from JP Morgan, and then you're going to be my boss. My family owns 25% of this. Why don't I just go take out the cheap debt from JP Morgan myself, special dividend out to my shareholders. We'll still be in control, and our public shareholders who trust us, like, will kind of be rewarded over the long term from that." I just thought that was a really interesting way of showing like how they do think about the long term and creating long-term value and kind of partnering with shareholders. I don't know if you want to add anything there.
Yeah, no, I just think that shows their long-term mindset. And, he was 100% correct in that kind of assessment. You have to think about it now, though. He's, that was, 13, 14, 15 years ago. He's not getting any younger. He has to think about succession planning. He has the son who's shown a real interest in the Hawthorne business. So this could be a great way for him to ride off in the sunset. I'm not saying this is what they're going to do, but it's at least an option, and would kind of, another reason why that $50 million a year in dyssynergies might not be as big of a deal.
You're totally right. And, as you said, it's not just Berkshire who would love to take the Scotts core business. This is every private equity firm would love to slap 7x turns of leverage on this, buy it, and probably go on a little bit of a bolt-on acquisition spree. I'm sure there are plenty of consumer brands, nothing like jumping right off the top of my head, but I'm sure there are plenty of big consumer brand companies that would love to buy this for the relationships, the bolt-on. Like, there would be synergies with other buyers if you wanted to split this off into two. So I definitely hear you there. Jon, I think we've been talking for almost an hour at this point. I think we've done a really nice job of covering all the different pieces of Scotts. Anything else on Scotts we should be talking about before we kind of wrap this up?
No, I mean, listen, I think this is not one of these stocks that's going to, that I'm saying is going to double overnight or anything to that extent. I think this is a great.
Are there any stocks that you say would double overnight? I'd love to go check those stocks
out.
No.
I'm just saying, I think this is a great long-term risk reward story. It ticks out a lot of the boxes that we look for: investment, great consumer franchises, family control, things like an owner. So I think it's a really something to be, to look at. And I think, going forward, this is where I think investors are going to be making the money in stocks that are kind of outside the major indices or low index weighting. And, that's kind of things I think investors should be paying attention to.
Maybe it's just because I've been more focused on like eventier stuff recently, but I am surprised I haven't heard more about Scotts from, the people who love to buy and hold family run, long-term compounding business. Like, here you've got a CEO who, go read some of the quotes I posted or go read the Investor Day. It's a CEO who talks very openly and honestly about trying to create long-term value. He views long-term value, free cash flow growth over time is what's going to do it. CEO who's beat the indexes, over the past 20 years, the stock's up like, it's a 12 bagger. Whereas if you invest in the Russell, that's under 5. So he smashed the indices over long-term. I'm just surprised I don't hear more people kind of talking about it in the, you're probably not going to make, as you said, a double overnight or a double in a year, but you're probably going to do really well over time with less risk than the indexes. I wouldn't be surprised if you outperform pretty significantly over a 5-year period or something. I'm just surprised I haven't heard more about it.
Yeah. I mean, I think a lot of people just, don't want to invest in family controlled businesses. That's one of the things they don't like that. But I'm kind of perplexed. It's a brand that almost everyone, at least in the US, knows, or, it's a great brand. So I'm not sure why it hasn't gotten the attention, but I guess it's not a Meta. It's not, it's not Google. It's not, any of these kind of, high flying businesses, but sometimes boring is okay.
Meta's market cap drop, what was it? It was the largest market cap drop of all time, $250 billion on earnings. So maybe it's a good thing it's not a Meta right now.
Absolutely. It's absolutely crazy. But I think it's a really interesting idea. And, thank you for inviting me on to talk about it.
I'm going to let you go once again, but before we do, I just want to bring it back to the Forgotten 40. Obviously, we talked about one of the 40 stocks. What else on the Forgotten 40 is really interesting to you these days?
I mentioned Callaway as one that I think is interesting. We've talked about in the past before. You and I know you have different feelings on another family-controlled business. Both Madison Square Garden sports and entertainment, are interesting. The Dolans are, have their own set of issues, but they have a fantastic asset.
Did you see my podcast with Chris McIntyre on MSG? I think I introduced you guys separately, but did you see that?
I spoke to him. I haven't seen that. He talked about E or S or both.
He talked about E. He did really good work, I thought, just on how a lot of the debt at E is non-recourse. So even if you ran into a disaster, you're buying this, and MSG, the garden assets are great. The Rockettes, I love the Rockette. I'm with, every time I look at those, they play exactly into my worldview of like where the world's going and the compounding assets over time. But man, the Dolans have just really burned me out, and the Knicks have been such a bummer this season. It's hard for me to get excited about them.
Yeah, I mean, I know, after talking about cannabis, talking about sports gambling is probably, I don't want people to think I just invest in sin stock, but like that's a huge, growth engine, both for E and Madison Square Garden, E and S. I mean, if you look over the last month or so, how many people signed up for DraftKings and all these other things because they legalized sports gambling in New York. This is going to be the premier place to advertise it. And, with giving 9 licenses in New York, they just instantly got 9 customers to sponsor them.
I did a few posts on the giveaways that the sports gambling companies were giving. It was crazy, but more than that, the advertising is out of this world. And, people don't think about things like the Staples Center. They get that crypto partnership for, I think it was $250 million over 10 years or something. I can't remember the exacts, but, Madison Square Garden doesn't have that. But 10 years ago, if I had come to you and been like, hey, these companies are going to be getting $20 million per year from a crypto firm, you would have said, crypto? What's crypto? And there's all these new categories that are always sprouting up, and people always want the brand halo of either the biggest arena in the world, which is MSG, or the Knicks and Rangers and stuff. So I just think they play so well over time, but gosh, the Dolans have just really bummed me out with a bunch of their decisions recently. And we talked about how bad the MSG and MSG deal is. So I know you're kind of with me there, but
no, I'm with you with the short term and the long term. Just remember, they bought when they owned Cablevision, they bought at Madison Square Garden that owned the Knicks, the Rangers, the Garden itself, and a whole other and real estate and air rights for a few $100 million. Now, the Knicks alone was valued at $5 billion. So take the long-term view. Although I realize, clients aren't so forgiving, but in the long term, they've created a lot of value. And the other thing to remember is they did sell to Altice at the right time. So they are sellers of assets. So, I wouldn't give up on them, but it's been a frustrating ride recently.
I'm with you. It's one of those ones, one day they're going to sell and the stock's going to go up 150% that day or something because the asset value is so clearly undervalued. It's just a question of, I wish that there were the rumors that day was going to be like 2019 or 2020. I wonder if that day is 2 years from now, or if it's 20 years from now, and you and I'm going to have a lot more gray hairs on my head, and we're going to say it finally happened, but we way underperformed along the long way.
The one thing to talk about, to mention with that is, listen, and I'm guilty of that too. I've been saying for years, sell the Knicks, sell the Rangers, whatever. The right move has been to hold on to this, and they've created value a lot more than just investing in the S&P 500 by just holding on to these assets and compounding tax-free. So he's done the right thing. It's just doesn't feel that way.
Again, I agree with you, but the right move has been to hold on to the Knicks because the NBA has done great and that rising tide lifted all boats. But in many ways, the Knicks have hindered the NBA because they're the premier franchise in the premier market. And for 20 years, they have been managed like a joke. They've been awful. I mean, more than half the teams make the playoffs in the NBA, and the Knicks have made the playoffs 3 times in 20 years with all the advantage a big sports team has. They have outperformed, and it's been the right thing to hold on. But what would have been even better if they had been run properly and, winning titles and stuff, which a New York team kind of has the right to do more frequently than any other team. And they haven't done that. So it's just the Dolans, man, the Dolans.
Yeah, I think that's, no, absolutely. But it's, these are the situations we look at there. It's really not for everyone when you take a longer term view. And, we also, in the Forgotten 40 have, we talk about it next time or whatnot, but some growthier names like Uber. So we're not like just a traditional value firm.
Yep.
We take kind of as I said, a business person's approach. So it's
Uber.
Interesting. There's a lot of opportunity, and January gave us a lot more opportunity.
That's true. That's true. Well, hey, John, we've been running for an hour, so I'm going to wrap it up there. For anyone who wants, in the show notes, I'll have links to Forgotten 40. John, if you'll send me the link to the Scotts Miracle-Gro, I'll put that too, so people can see kind of the numbers behind some of the parts and everything we've been talking about. But John, this was your 3rd appearance, and I'm already looking forward to the 4th. Thanks so much for coming on.
Thanks for having me.